Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I think it's time to interrupt our previously scheduled content, which was 22 trading resolutions for 2022, and talk a little bit about the bomb possibly blowing up. And that's going to make a little more sense in 1 second. We have a new mystery chart. It's actually a buy, believe it or not, and not a mystery chart. It's a live setup. Housekeeping, I do take requests. If there's something you want me to cover, send me an email at www.davelander.com/contact. I'll be happy to cover it. It makes my job a lot easier knowing ahead of time what you want me to talk about. If I can't fit it into this venue, which has a bit of a limited time slot, I can work it into my weekly webinar that I do, Dave Landry's The Week in Charts. You can find it at davelander.com/webinar. If you want slides from this presentation and all the other presentations combined, which have the rules to a lot of the stuff we're going to talk about today, and a bunch of other stuff, and also limited access to the members area, books in PDF format, and a bunch of stuff to keep you busy for a long time. As I say, get to know me first. Go to davelander.com/StockCharts and put your info in. All right, let's talk about the mystery charts and the methodology in action. Here's our mystery charts for today. Here's the parameters down here. You can see it's a buy. This is the actual open model portfolio that I run. It's a buy at 530, stop at 410, and an IPT of 650. Now, those parameters seem a little wide, but look at this thing. It's doubled over a short period of time, or nearly doubled. So it's a very volatile stock. As you can see, nice thrust from lows, bit of a pullback. That's a pattern I call a first thrust. Entry is here, the stop goes here, if triggered, of course, and the initial profit target is up here. Now, you might also notice it's a big picture cup and handle type pattern, and also a pattern I call a bow tie. Now, here's one that we're short that I still think has potential. So far, it hasn't worked out, but I think you could re-short this one. Let me show you the original parameters. We sold short here, and if you look, you can see this is where we got in, 119.50. So far, fairly miserably. That's based on yesterday's close, 124.22. But so far, it's come back a little bit today, or slid a little bit in our favor. This stock hit all-time highs here, or multi-year highs, I should say, began to implode and pull back a little bit. So that's an inverted cup and handle, a pullback, probably also a bow tie. And if you were to get in again, maybe look to enter below this low here as a possible short. Now, the question is the bomb now blowing up? And the reason I'm saying that is back when the market was making new highs several months ago, I thought it'd be a good time to do a presentation on market timing. And I called it Before the Bomb Blows Up. And the reason I named it that is because friends and relatives and other people in general don't really call me up when things are going well, or if things are going a little bit rocky. They wait until they're down 30 or 40% or more, and then they call me in a bit of a panic asking me what to do. Well, by that time, the bomb has already blown up. So my whole point there was, with market timing, you have to get ahead of it. Now, let's just take a look real quickly at where we are with the TFM 10% system. My goal today is not to explain the system in its entirety, because we've done that before, but rather give you a bit of a thumbnail to show you how it works so you can see where we are. Anyway, if a market's going to go from A to C, and B is in between A and C, it's going to have to pass through B along the way. Now, as I often say, you can't always just blindly buy a market at B, although I do have an IPO pattern that pretty much does just that. But you'd be much better off looking to buy as a market is going up and looking to get out as a market is going down. So if it's going to go beyond C, not to be confused with Beyonce, it's going to have to near C along the way. And conversely, on the downside, it's going to go below, near C, and through B, on its way to A. So take a look at the S&P 500. This is a weekly chart. So C was new highs we made back in January of 2020. And then B is somewhere in between those new highs, and A would be the lows. Now, I have what's called the buy line, and you could also say that's the near C line. And I have it set for 10% below the 50-week closing high. And it's illustrated here in this chart. Down below is how far away we are from that high. As a general statement, as long as you're within 10% of all-time highs, as a general statement, as long as you're within 10% of 50-week closing highs, the market is generally in pretty good shape and you could stay long. When it begins to drop more than 10% away from the 50-week closing high, you might want to consider exiting the market. So you can see once it drops below 10%, not all the time, but sometimes it begins to worsen. Now, if you take a look at the market when it's within 10% of its all-time closing high, as a general statement, it usually pays to stay long, as I have illustrated here. Now, without going into a lot of detail, I also have a whipsaw filter, which is the 50-week moving average, and any close below that would be a sell, provided that it also closes below the 10% buy line or the near C line. Now, if we zoom in on recent action, you can see even with the big slide we had on Monday, January 24th, the market closed above both the buy line, or the near C line, and the 50-week moving average. So it's not quite a sell signal just yet, but it's getting dangerously close to those levels. And right now, that would be 42.89.56 on the S&P 500. Now, let me just talk real quick about Landry Light, and we're going to get into it a little bit more detail in a few minutes. But I want to show you this real quick before we take a look at the spreadsheet. You can see that Landry Light, by the way, is lows greater than moving average, and I have it illustrated down here. I call this an illustrator, not an indicator, because it doesn't tell you what the market's going to do, but it tells you what the market has been doing. It illustrates it, and in general, if you've got a nice trend in place, it will continue. So that for the most part, as long as it's green, and you could use your favorite moving average, and I'm just using the weekly because that's what we use in the TFM 10% system. But as long as it's green, generally stay long. If it gets red, become a little cautious or possibly exit the market. If you're more advanced, you might look to short. And again, green, stay long. As I've done presentations before, Tarzan speak, green, good. And a little red here, you can see the market got a little iffy. We went green again, and of course the pandemic slide, we turned red on the 50-week Landry Light. Now, I don't wait for downside Landry Light with the system. All I'm looking for is a close below the 50-week moving average and a close below the buy line. That's a sell signal. Anyway, up until just recently, within hours ago, we were above the 50-week moving average, and the Landry Light was green, and we had a really nice trend in place, and now we have gone down to kiss that moving average. Not the end of the world, but this is a part, or this is a point in time, I should say, where you want to pay attention. Now, I don't want to spend too much time on a spreadsheet because I know your eyes will glaze over. Anytime you see a spreadsheet or presentation, you begin to say, oh boy, oh geez, as we say in Fargo. But anyway, this is buying hope, $2 million, going back to the 20s, and $5 million in change, or $5.5 million using a little market timing, something really simple like this. Now, even though it's a trading system, you could see there's not a whole lot of trades going back almost 100 years. And this system spent 29% of its time out of the market, or 28 years. What I did want to show you is some of the diaper change moments in here. 80%, 40%, sometimes 25% or more, 40-something percent. It's not that uncommon to see these big slides in the market. Of course, the last two major bear markets we had were 44% and 52%. And then, for all intents and purposes, the pandemic slide was the bear market. And believe me, when people were down 30 and 40%, they started calling me in a bit of a panic. Now, if you want to obviously look at this spreadsheet in more detail, you can get the slides from davelandry.com/StockCharts. My favorite moving average lately has been the 30 EMA. I know you probably want to party with me. But you can see for the most part, we had one little speck of red, I believe, during this entire trend, and a couple kisses of the moving average, which will cause this to go to zero. This just counts the number of days the lows are greater than the moving average. And you can see back in last October, the market was chopping around a little bit, and we did start to get a little red. Market was a little questionable. We resumed the uptrend for the most part since, and now based on that 30-day EMA, again, we're beginning to see some red. So the market obviously a little bit questionable now based on that indicator. Now, the 50-day simple moving average is a well-watched moving average. So if you want to take a look at the Landry light on that, you can see it stayed green for a long time. And we had a little red, obviously, last October. A little speck or two of red since, but for the most part, the market has worked its way higher, obviously, up until now, and it has begun to slide, obviously. The 200-day simple moving average, not that you want to use this as your signal because it might take a while for it to trigger, but it can give you kind of a 30,000-foot view of where the market is. And that's been green up until yesterday. And we've had Landry light, as you can see, lows graded moving average for a long time. What's kind of interesting is if you go all the way back to 2020, you could see after the pandemic slide, we've had green Landry light for nearly that entire period of time using the 200-day simple moving average, and obviously it turned red during the pandemic slide. So now we're on the cusp of going red on that. It won't be the end of the world, but you do want to pay attention to that when it occurs. Now, the 50 and the 200 are often watched together for the death cross. And if you take those signals, the death cross and the golden cross, you probably will do, well, I wouldn't say okay. You'll probably maybe scratch out longer term. A friend of mine, Rob Hanna, I believe, said that it's about a 4% edge, which is really not enough to bother with. But what it does do, like any other trend signal, is it will alert you, A, that the market could be in trouble, and B, what's more important than the signals in and of themselves, because if you wait around for the market to cross back up, you might be waiting for a long time. What's more important is the potential diaper change moment in between. In other words, how much the market loses after a potential death cross. In this case, it was a 54% diaper change. I stole that term, by the way, from Ian McActivey. He's no longer with us, but Ian used to have the best presentations in the world. But anyway, following it on a net basis, it's only a 38% drop. But anyway, the point is, once you get a sell signal, bad things can happen. A gentleman by the name of Gayard did a paper a while back titled Where Bad Things Happen. And the point is that below the 200-day moving average, bad things tend to happen. So the diaper change moment, as I have labeled them, happens below the 200-day moving average. So pay attention to that moving average. Now, I want to touch upon bow ties briefly. Bow ties is just a moving average coming together and beginning to spread out. On the short side, ideally coming off of all-time highs, long side, major lows such as multi-year lows. Energies, for instance, could have really good patterns coming off of major lows. Gold sometimes. For the overall market on the short side, I like to watch, again, all-time highs. So the market has bow tied to the downside. Now, this just tells you the order of the moving averages down here. Green, Tarzan speak, is good. Yellow means they're beginning to cross back and forth, and red means they have completely crossed over. So green, good, right? And then yellow, you might want to be a little cautious when that begins to happen. Green, as a general statement, is good. And you can see that it stayed green for a long, long time. Nice little uptrend. They turned yellow, meaning that the moving averages are beginning to cross or crossing back and forth. And then they turned red, as you can see, in this little slide that we had back in October. They went back to mostly green, a little yellow in between since, and then now we flip back over to the downside. And you can see the 10 is less than the 20, and the 20 is less than the 30. So 10, 20, and 30. 10 is simple, remember, 20 is exponential, and the 30 is exponential. If you were to short a market, or if you're waiting to sell based on this signal, you would wait for the market to bounce and have a higher high and a higher low. So this could actually set up fairly soon as a bow tie on the short side. If it keeps going up, though, that would be great, right? We survived this correction. Now, if we switch gears and take a look at a weekly bow tie, as you can see, it gives you a much bigger picture view. We did have some consolidation back in 2016, and some of those slides were pretty serious. So it probably would have been a good idea to be out of the market for the most part back then. And you can see mostly red then. We went back to green. And as you can see, it got a little questionable back here. Turned red. Market had a pretty good slide. If memory serves, that was a decent drop in the overall market. Certainly more than 10%. And then obviously it would begin to rally afterwards. And then, of course, the pandemic slide, you can see the moving averages flipped over to the downside. Now, again, these are weekly moving averages. And the point is that they could help you stay on the right side of the market. But I wouldn't wait until they completely cross over to become concerned, okay? But you can see so far there's still an uptrend proper order. And so far the market has done okay, sans this little correction that we're in now. But do pay attention to these longer term. If the market has a bit of a gradual rollover, they will flip over to the downside. Now, if you see a market where everything gets sold, sort of the baby getting thrown out with the bathwater, so to speak, that's when you need to be concerned. So if you come in and gold's getting creamed and bonds are getting creamed, in other words, there's no place to run, no place to hide. People aren't looking to those assets for safety. They're looking to just get out of those assets. That's when things can become a little ugly, and that's when you need to be a little careful. Now, so far, gold's kind of hanging in there. I wouldn't rush out and buy gold, but it's kind of hanging in there. What's interesting is, and this is a bit of a bummer, and I guess I'm kind of a bull longer term on cryptocurrencies, specifically Bitcoin. But what is, and obviously Bitcoin's in a downtrend. You can see the bow tie moving averages proper order here. Red means that 10 is less than the 20 EMA, 10 simple, less than 20 EMA, and then 20 EMA is less than the 30 EMA. And this is another one of those little trend indicators. You could use this also in the overall market. And right now, S&P 500 obviously is in downtrend proper order. So that's another one of those clues based on the market strength, or lack thereof, I should say. But anyway, what bums me out a little bit about Bitcoin is there was hope and promise that this was going to be an inflation fighter and limited, because it's limited, which that's a whole nother argument in and of itself, but because it's very limited supply. And by the way, I think if the true supply of Bitcoin was really 18 million, 21 million max, then Bitcoin should be worth $1 million each. But that's another conversation. There's a lot of paper Bitcoin out there, so to speak. But before I get off on a tangent, it's a bit of a bummer that Bitcoin is not a place to park money during this potential market slide. So that's a bit of a bummer. Now, I've just kind of scratched the surface here, but do pay attention to these signals for when they trigger, and I will update the signals in upcoming shows, but ideally you want to pay attention to those on your own. And look to get ahead of it. It's not the end of the world just yet. We don't have these major signals just yet, but actually on a bounce, in some cases, we'll have bow tie setting up and other potential signals. And obviously, the markets are in downtrend proper order, as I just said. So we need to pay attention to all these things. Honor your stops on existing positions. Maybe look to focus on areas that so far are doing okay, such as the energies. And other than that, unless you're going to short, probably the best thing to do is sort of sit on your hands. So look to get ahead of it before the bomb blows up. Well, that's all my time for today. If you need to reach me again, daveleonard.com/ contact. If you want the slides from this presentation and all the other presentations combined, plus enough stuff to keep you busy for a long, long time, go to davelandry.com/StockCharts. Thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.